A bond fund can pay you every month and still make your capital look like it fell down an elevator shaft. That is the uncomfortable puzzle on today's table. An income stream that has delivered plenty of cash, a payout that has been cut sharply from its early level, and a share value path that forces us to ask whether the fund is earning income or slowly mailing investors pieces of their own house. Today we're dissecting the iShares Investment Grade Corporate Bond by Right Strategy ETF, ticker LQDW. This is not a plain corporate bond fund, and it is not a stock-covered call fund wearing a bond costume. It is a layered machine. The foundation gives investors exposure to a broad basket of US dollar investment-grade corporate bonds. On top of that, it writes one-month call options against the bond exposure. In ordinary English, the fund owns a bond market engine and rents out some of its potential upside for 1 month at a time. The rent is option premium, and that premium can support monthly distributions. The catch is that the tenant gets part of the good view. When the underlying bond position rises strongly, the written calls can limit how much of that rise the fund keeps. When bonds fall, the premium may soften the landing, but it does not install a floor under the portfolio. That asymmetry is the whole case. Investors receive cash now while accepting that the capital account may recover more slowly or fail to recover at all. This video is for research and education only. It is not financial, investment, tax, or legal advice, and it is not a recommendation to buy, sell, or hold any security. ETFs can lose value. Verify the current prospectus, distribution notices, tax documents, holdings, and other official fund materials for yourself, and consult a qualified professional who understands your circumstances before making a decision. Let's check the vitals as of August 20, 2026. The fund pays monthly, charges an expense ratio of 0.34%, and has $319 million in assets under management. It launched on August 18, 2022, and is issued by BlackRock. Its category is corporate bond, its asset class is fixed income, and its rulebook is a bond buy right index. Those details matter because they tell us what job this product was designed to do. This is not trying to find one brilliant bond manager or make a heroic interest rate forecast. It passively follows an index recipe. The portfolio supplies diversified corporate credit exposure. The recurring option overlay attempts to convert some market volatility into spendable cash. The monthly schedule can be useful for someone matching portfolio income to regular expenses, but frequency is not quality. Regular envelopes do not prove that the money inside them came from profitable months. The real test is whether the portfolio's remaining value and cumulative distributions together leave the investor better off. The current run rate is 10% based on annualizing the latest 4 payments. That is the honest lead number because it approximates what a buyer today would collect if those recent payments repeated. The latest distribution was 20 cents per share, and annualizing that single payment also produces a mechanical rate of 10%. The trailing 12-month yield is 12%. That historical figure is higher because it still includes older payments that were larger than the recent pattern. This is exactly why a yield quote needs a timestamp and a method. The backward-looking number describes cash that was paid. It does not promise cash that will be paid. A 10% run rate is substantial for a portfolio built around investment-grade corporate bonds, but it is not a free upgrade to the underlying bond income. Part of the headline cash flow comes from packaging market exposure differently. A prospective investor should therefore ask 2 separate questions: how much cash could arrive, and what may happen to the value of the claim producing it. The first question attracts attention. The second determines whether the income is actually enriching you. Time for the history and the direction is unambiguous. The first 4 distributions averaged 62 cents per share. The latest 4 averaged 19 cents. The payout has fallen from its launch period level to the latest paid rose. That does not mean the next payment must fall again. Option income can vary with volatility, option pricing, and movement in the underlying bond market. But it does mean an investor cannot responsibly build a spending plan around the opening act. Early distributions were not a durable baseline. This decline also explains the gap between the current run rate and the trailing yield. The higher trailing measure is carrying the ghost of richer checks. For someone who bought recently, those old payments are museum pieces, interesting evidence but unavailable income. The practical lesson is to inspect the sequence, not merely the sum. A monthly fund can look dependable because the calendar is regular even when the amount is not. If household expenses are fixed while distributions float, the investor, not the ETF, absorbs the budgeting risk. That makes payout consistency a separate feature from payout frequency. Now we open the capital account. Net asset value is $23.34, compared with a launch reference price of $39.71. The NAV return since inception is negative 41%, and the maximum drawdown is negative 42%. That is not a cosmetic decline. NAV is the productive base still working for each share. When that base shrinks, future gains must climb from a lower starting point, and future distributions are supported by a smaller pool of capital. A falling NAV can coexist with legitimate income, but a persistent fall changes the economics of the ownership experience. Consider two different bond market paths. If corporate bonds rally sharply, the call overlay can surrender some gains that a plain bond position would have kept. That can make rebuilding NAV harder after a decline. If corporate bonds sell off, the collected premium provides only a limited cushion. The fund still participates in the underlying damage. In a choppy, range-bound market, the option program may look clever because premiums arrive, while much of the bond exposure stays in place. In a strong recovery or a deep sell-off, the compromise becomes more visible. The drawdown also matters psychologically. An investor may tell herself that price does not matter because the monthly cash is the goal. But a large capital decline can force difficult choices if circumstances change: sell at a depressed value, reduce spending, or wait for a recovery that the option overlay may partially cap. Income does not erase liquidity risk. Cash distributions since launch total $18.22 per share. Once those distributions are included, the simple return since inception is 5%. That positive result deserves to be stated plainly. This has not been a case where every dollar disappeared. The distributions more than offset the loss in share value under this simple calculation. An investor who collected every payment had a very different experience from someone staring only at the price chart. But the composition of that return is still awkward. A small positive overall result was delivered alongside severe capital shrinkage and a much lower recent payout. That matters because spendable cash and preserved principal are not interchangeable for every investor. Someone who consumed all distributions has less capital left in the fund. Someone who reinvested them may own more shares, but those purchases do not make the underlying economics disappear. This is why total return is the referee. Yield measures cash relative to price. It does not tell you whether the investment created wealth. NAV alone is also incomplete because it ignores cash already delivered. Put both together and the story is neither total failure nor clean success. The investor finished modestly ahead, but arrived there through a route that demanded a great deal of capital tolerance. Here is the machine under the hood. The fund uses a fund-of-funds structure. It holds shares of the iShares iBox USD investment grade corporate bond ETF, then writes 1-month call options against those shares. The CBOE LQD by right index measures that combined position, and the ETF passively tracks the index. The underlying sleeve owns a diversified basket of investment-grade corporate debt rather than a list of handpicked common stocks. Those bonds respond to several forces. Changes in market interest rates can move bond prices. Changes in corporate credit spreads can reward or punish the basket even if benchmark rates stand still. Investor demand for higher quality corporate debt can also shift the underlying value. Then comes the buy right overlay. The fund sells calls, receives premium upfront, and accepts an obligation tied to upward movement in the bond ETF shares. If the underlying finishes below the option's relevant threshold, the call may expire without taking away further upside, and the premium stays in the portfolio. If the underlying rises through that threshold, the written option becomes costly and offsets part of the bond sleeve's gain. In effect, the fund repeatedly sells a slice of tomorrow's possible appreciation to help finance today's distribution. That trade can work best when the bond basket moves sideways or rises gently enough that option premium matters more than surrendered upside. It can disappoint during a powerful bond rally because a plain position can participate more fully. It can also disappoint in a hard decline because premium is finite while market losses are not limited to the amount collected. Imagine corporate bonds are battered by rising yields or widening credit spreads, then rebound quickly when conditions reverse. The first leg hurts the underlying sleeve. During the rebound, short calls may prevent the fund from capturing the entire recovery. The strategy can therefore lose on the way down and recover with a speed limit on the way back up. What should you watch from here? First, compare each new monthly payment with the recent sequence, not the launch checks. Stabilization would strengthen the case that today's income level is usable. Another step down would show that the reset is still in progress. Second, watch whether NAV can hold ground across different bond environments. A period of stability while distributions continue would be healthier than cash payments accompanied by another persistent slide. Third, examine current distribution notices and tax documents for the stated sources of cash. Do not assume that every dollar labeled a distribution represents interest earned by corporate bonds. Fourth, compare performance with the plain underlying position during both rallies and sell-offs. That reveals whether premium is providing enough benefit to compensate for upside surrendered through the calls. Fifth, monitor the forces acting on corporate credit, interest rate changes, spread widening or tightening, and signs of stress among investment-grade issuers. The option overlay changes the ride. It does not remove the road. Finally, decide what role the fund would play before looking at the next payment. If the objective is stable principal, variable cash supported by an options overlay may be a poor fit. If the objective is aggressive current income and the investor can tolerate capital volatility, the structure is at least coherent, but the spending plan still needs room for payment changes. On life support, the diagnosis is not that the fund has produced no value. Distributions included, the investor is ahead. The diagnosis is that the positive outcome has depended on heavy cash extraction while the capital base deteriorated and the recent payout fell to a fraction of its opening level. That combination leaves very little room for complacency. A future improvement requires more than another monthly deposit. It requires evidence that the remaining portfolio can preserve value, support a steadier payment pattern, and stop forcing investors to choose between income today and a shrinking claim on tomorrow. For an everyday investor, the clean question is not, did I get paid? Of course you got paid. The question is, after getting paid, what condition is the patient in? Here, the pulse is present, the total result is still positive, but the capital damage and payout reset keep this fund far from a clean bill of health. 2 quick things before you go. If this teardown helped you see past the headline yield, hit the like button, it genuinely helps the channel. Subscribe so the next ETF autopsy lands in your feed. And drop a comment. Which ticker should we put on the table next, and where do you think the real risk is hiding? We read everyone. Thanks for watching.